Hi, I'm Corey Brown. I'm originally from Austin, Texas, and I am a first-year MBA student at the Naveen Jindal School of Management. I'm studying for an MBA and a concentration in finance.
Hi, my name is Parker Fulton. I'm a second year student at the University of Texas at Dallas. I'm currently getting my MBA with a concentration in finance and data analytics.
Hi, I am Farid Farooq. I was born and raised in Pakistan. Currently, I'm doing my Master's in Business Administration from UT Dallas.
Hi, I'm Keshav Malsaria. I'm a first year MBA student at UT Dallas and I'm pursuing my MBA in finance.
Hi, I am Ravindra and I am currently a second year MBA student at University of Texas at Dallas.
Welcome to our appraisal analysis of North Star Casting Company. At the request of the trustee of the Employee Stock Ownership Trust, we are conducting a valuation of North Star Casting Company to establish an appropriate price for employees to buy and sell shares held in the trust in accordance with relevant regulatory and professional valuation standards. We have completed our analysis of the company and are prepared to present our proposal. First, we'll provide a brief overview of the North Star Casting Company and the die casting industry as a whole. Next, we'll discuss North Star's positioning, including management's assumptions and financial projections. We'll then review our valuation methods and guide you through the various approaches we used. Finally, we'll present our proposal along with the supporting rationale. Let's go ahead and get started. Founded in 1918, North Star has a long-standing reputation in die casting, evolving under family ownership and later transitioning to ESOP ownership in 2021. This ESOP transaction also marked a leadership change, with Greg Smith assuming the role of CEO. Key leaders include CEO Greg Smith, President Brian Anderson, and Chairman George Hardman. North Star's core competencies include precision aluminum and magnesium die casting, and key end markets include automotive, medical, defense, aerospace, HVAC, and recreational. Here we highlight North Star's 3 manufacturing facilities, which are shown in red, in contrast to their main competitors' facilities, shown in blue. For North Star, Chicago, Illinois marks North Star's corporate headquarters and primary aluminum die casting facility. Indianapolis, Indiana, a fully automated aluminum die casting facility, and Cleveland, Ohio, a magnesium-focused plant that transitioned to an 100% magnesium production in 2023, a milestone that aligns with North Star's strategy to capitalize on industry growth trends. Currently, there are over 400 US-based die casters. The majority of these competitors are focused mainly in aluminum and zinc die cast products. North Star's customer base is centered around the automotive industry, with many of their largest customers being Tier 1 and Tier 2 suppliers to automotive OEMs. However, they have a focus on expanding this base. North Star utilizes an internal sales policy to limit reliance on any single industry or customer, maintaining customer and industry diversity to reduce risks associated with industry cycles. Currently, they are restricting automotive sales to less than 50% of total sales. The policy further aims to prevent any single customer from accounting for more than 20% of company sales. Once a customer reaches 15% of total company sales, management begins closely monitoring the relationship. Management believes this approach helps reduce risks related to sales concentration and industry cyclicality, especially in sectors like automotive. We will now discuss the die casting industry dynamics and North Star's positioning. An analysis of Porter's 5 forces shows North Star is strongly positioned in the market. The die casting industry holds high barriers to entry. Substantial capital investment and required technical expertise make it unlikely for new competitors to enter the market. Raw material suppliers hold significant leverage due to the commodity nature of aluminum and magnesium, with price fluctuations that North Star must pass on to customers. North Star stands out among industry rivals due to its advanced manufacturing facilities, which are automated and optimized to focus on the growing demand for magnesium products. Across various industries, we are seeing a growing demand for magnesium casted products. Magnesium's lightweight and durable properties make it ideal for industries focused on reducing weight and increasing efficiency. Automakers are using magnesium in structural components like frames and housings to enhance fuel efficiency and lowering emissions. In aerospace, the corrosion-resistant nature makes magnesium a preferred choice for aircraft parts, helping reduce fuel use and emissions. Medical equipment frames benefit due to its lightweight and corrosion resistance. And within electronics, magnesium's thermal properties make it ideal for heat sinks, castings, and components. Given the multi-industry-wide shift toward magnesium die-cast products, Northstar is well positioned to capitalize on this growing trend. Northstar possesses industry-leading expertise in magnesium. They have secured new customer contracts specifically calling on magnesium products, and as of 2023, they operate a fully dedicated, optimized magnesium manufacturing facility in Cleveland, Ohio. As you can see, the industry is growing and evolving, driven by increased efforts among manufacturing facilities to automate processes, invest in capital and specialized equipment, and the exploration of new materials. Northstar Casting Company's focus on innovative technology and specialization in magnesium casting position the company for success in the highly competitive die casting industry, highlighted by their strengths in operational efficiency, which management has strategically focused on improvements over the historical period, leading to growing profit margins. Expansion into diversified markets, represented by new contracts in industries they haven't participated in before, such as the agricultural industry. Consolidating tailwinds, in which Northstar is expected to capture customers from two large competitors that recently filed for bankruptcy. And a positive market outlook, in which the automotive industry, of which is a core focus for Northstar, is poised for significant growth. We will now discuss the way that Northstar management sees the business and what assumptions they have projecting forward. Northstar's management projections of their income statement reflect steady sales growth and consistent gross profit margins throughout the projection period. Sales are set to grow at a 9% CAGR with a residual growth rate of 3% based on the following assumptions. Sales growth stemming from continuing and expanding existing programs, of which management has identified nearly 100% of revenues through 2026. Growth from new business opportunities, of which management has identified a number of targeted automotive and non-automotive prospects that fit within the company's core markets and capabilities. Pursuit and conversion of these targeted opportunities is integral in Northstar's ability to achieve these projections. New and replacement business from currently quoted opportunities in which Northstar, due to new leadership, has increased quoting volumes. And lastly, expectations for additional quoting opportunities in the future. Now we will review evaluation from management's perspective, using their projections from the income statement and balance sheet for the period from 2025 to 2029. In this chart, we are showing Northstar's historical sales and projected sales. Northstar's focus on operational efficiency has led to steadily improving gross margins, except in 2021, which was impacted by supply chain disruptions. However, sales growth has lagged with a historical 4-year CAGR of negative 1.6%. Management now projects a 9% revenue CAGR going forward. Although market research indicates continued softness in end markets through 2025, demand for high-performance aluminum alloys is expected to strengthen beyond that. Management forecasts flat year-over-year sales in the near term, followed by 12% growth in 2026 and low double-digit growth in subsequent years, resulting in a 5-year CAGR of 9%. They also project gross margins to stabilize at 14%. EBIT and EBIT margins have steadily improved over the past few years due to gross margin gains and disciplined operating expense management. EBIT margins increased from 1.3% in 2021 to 4.8% in 2024. Looking ahead, management anticipates further growth, with EBIT margins expected to reach around 6% by 2027 through 2029. This reflects their confidence in maintaining efficient operations and a stable cost base to support ongoing margin improvement. Northstar has demonstrated consistent growth in its actual EBITDA from 2021 to 2024. The projections suggest this trend will continue through 2029. In 2024, Northstar's EBITDA of $5.2 million exceeded the planned EBITDA by 15.6%. The increasing EBITDA margin indicates that Northstar expects to improve its profitability over time. This is reflective of their intense focus on operational efficiencies. Management expects that continued strong plant leadership, efficient maintenance functions, a leaner management structure, and economies of scale will bolster operating margins, allowing management to shift its focus towards its sales vision without sacrificing profitability. The projected growth in both absolute EBITDA and EBITDA margins reflects management's confidence in future performance. Let's now review our methodology for calculating the cost of equity. For the build-up method, we used a risk-free rate based on the 10-year Treasury bond due to its higher liquidity compared to the 20-year bond. Our inputs included an implied equity premium of 3.96% as of October 1st, 2024, from Demodern, a size premium of 7.29%, and an industry risk premium of 0.12%. This approach resulted in a cost of equity of 15.6%. Using the CAPM method, we applied the same risk-free rate, equity premium, and size premium. We estimated the levered beta with the Demodern's bottom-up method, calculating the mean unlevered beta from Northstar's 5 closest competitors and relevering it to Northstar's ideal capital structure. This produced a relevered beta of 0.78, giving a cost of equity of 14.6%. The final cost of equity using the build-up method is 15.62%, and using the CAPM is 14.61%. In estimating the cost of debt, we applied Demodern's synthetic credit rating approach. Based on Northstar's interest coverage ratios from the last 12 months and projected 2024 equity, we arrived at a coverage ratio range of 3.4 to 3.5, corresponding to a BB credit rating. We used the current 10-year yield on BB corporate bonds, 6.24%, as the cost of debt. We calculated the WACC using both the build-up method and CAPM. The cost of equity, debt, and tax rates were incorporated using the machinery industry's average debt-to-capital ratio of 14.25% as a proxy for an optimal capital structure. This aligns closely with Northstar's historical ratios of 13.9% in 2020 and 14.4% in 2021. Although Northstar's current leverage is higher due to the ESOP transaction, we expect continued debt reduction to align with the industry standards and past levels. The resulting WACC values are 14.05%, the build-up method, and 13.19%, the CAPM. Using our calculated CAPM WACC of 13.19%, management's income statement projections, and a terminal growth rate of 3%, we determine an enterprise value of $22,247,000 through a discounted cash flow analysis. After accounting for debt and deducting cash, the resulting equity value is $10,125,000, giving a share price of $23.28. Applying a 5% illiquidity discount, the adjusted share price is $22.11. After performing a base case valuation of the North Star Casting Company, given management's projections, we recommend the following. An appropriate price for employees to buy and sell shares held in the trust in accordance with relevant regulatory and professional valuation standards is $22.11 per share.
However, this share price comes after considering the overly optimistic projections from the management. We have come up with our own valuations based on what we consider is more realistic for North Star to achieve in the future years. Our position differs from the management's projections because of a multitude of reasons. We will now discuss how, why, and to what extent our position differs from that of the management. The management assumes a CAGR of 9%. However, the historical sales figures of North Star do not support this very optimistic growth rate. From the years 2020 through 2023, sales grew at an average of only 2%, and in 2024 it fell by 9.7%. The operating margins, however, have consistently improved over the years, and so it is safe to assume that the operating margins will continue to steadily improve between 2024 and 2029, as projected by the management. Due to the management's record in improving operational efficiency and now the shift in the focus to improve sales, we expect the revenue to increase in the coming years. However, we project a 5.92% growth rate in the revenue because this rate is better aligned with the projected industry growth rate. The company has a policy to maintain no more than 20% sales from any specific single customer, which has led it to turn down some deals. Because of this reason as well, a 9% increase in sales seems very unlikely. Besides, North Star has only ever made projections of 1 year. Thus, it would not be prudent to take management's first 5-year projection at face value. Now we are going to take a look at North Star with comparable companies in the market. North Star has been able to have high gross, EBIT and EBITDA margins as compared to the market comps. This warrants our assumption of improved margins in the coming years. However, when we look at EBITDA and revenue growth side by side for North Star and its market comps, it is clear to us that improving profit margins does not necessarily translate to improving revenue. Though North Star has been able to grow its EBITDA over the years, its revenue has declined. This is why we consider a much more conservative growth rate of 5.92%, which also closely aligns with the industry growth rate. With the more conservative, industry aligned, and backed by historical performance assumptions, let us now look at our estimates and valuation. First, we start with the income approach. Here the line graph represents North Star's sales projections and the bar chart represents our sales projections. As we mentioned earlier, the management's projections are quite aggressive given the company's historical sales figures. For all the reasons mentioned earlier, it is much more likely that North Star will have a growth rate that is much more closely aligned with the industry growth rate. We do not believe that North Star will outperform the industry given the fact that the die casting and manufacturing industry is mature and North Star has been operating in this industry for over a century. Our more conservative sales forecasts give us a revenue figure of just over 60 million as compared to North Star's overly optimistic figure of close to $70 million for the year 2029. We do think that North Star will be able to continue to steadily and moderately improve its operating margins given its focus on operational efficiency over the last few years, which has helped them improve their operating margins in the last 5 years. With our sales projections, a terminal growth rate of 3%, and using the previously stated WACC of 13.19% to discount the projected free cash flows, we arrived at an enterprise value of $21,271,000. After deducting the debt and adding the cash, the equity value stands at $9,419,000. Dividing the equity value by the number of shares outstanding gets us at a share price of $21.03. After accounting for the illiquidity discount, the adjusted share price comes up at $19.98. We would also like to dive into how North Star stands against its comparable companies. We had a multi-layered criteria to select companies as market and transaction comps. Out of North Star's peer group of companies that had a similar core business in aluminum die casting, we first sorted out companies that had similar end markets as North Star does. We also accounted for only those companies which have a base of operations in the US. Lastly, we selected companies which had comparable operating margins to North Star's operating margins. We made two key assumptions while sorting the companies. First, growth opportunities and risk exposure to be similar across companies that meet the above selection criteria. Second, negligible control premium for the transaction comps. Looking at the relationship between the 3-year revenue CAGR and the EV over EBITDA multiples for North Star and its comps, we can see a pattern in which companies with higher growth have higher EV over EBITDA multiples. Since North Star's growth rate is the lowest among the comps, it is expected that it will fall well below all the comps with its EV over EBITDA multiples. And this is what we exactly see. With our income approach valuation, we estimated an EV over EBITDA multiple of 4.1 for North Star. Given its growth rate, it should fall around that number on this scatter plot. This gives us credence and backs up our valuation approach. Next, let us look at a football field analysis to get a range of possible share prices for North Star. Our football field analysis compares the implied share price range we derived from different valuation approaches. The first two pricing ranges result from the most recent private precedent transaction multiples in the casting and die industry. Both MVIC over sales and MVIC over EBITDA were considered. The implied share price ranges from $13.59 to $29.43 and $12.51 to $27.26 respectively. The third valuation range is from our income approach and sensitizes on terminal growth rates ranging from 2% to 4.2%. The implied share price range from the income approach ranges from $14.45 to $24.17. The final pricing range is from EV over sales multiples of the same publicly traded market peers used in the previous slides. The resulting implied share price range is from $21.9 to $26.49. Given these valuation ranges, we believe a fair price for employees to buy and sell shares lies between $20 and $22.
In conclusion, we believe that management's projections are overly optimistic, and we propose a revenue growth rate that is more reflective of the overall industry growth rate. As shown in the football field analysis, our income approach aligns closely with our market approach, which includes trading comps and private-to-private precedent transactions. And therefore, our recommendation is that the price per share should fall into a range between $20 and $22 per share. Lastly, we want to thank you, the judges, for considering our submission to come to Atlanta, Georgia for the final round of the Business Valuation Challenge in 2024. Thank you.